Happy Monday morning. This is Logan Freeman with Live Free Investments and Clemens Real Estate. I thought I would come to you and talk through kind of our investment thesis right now with the current multifamily market and just work through some different thought processes for looking at acquisitions right now. And so I want to start with this idiom that a lot of folks are talking about, which is waiting for the other shoe to drop. And that describes a situation where you're waiting for something bad to happen that you're certain is going to happen. And it's said to have its origins actually in the multifamily housing sector more than a century ago. Basically, you'd hear a thump as a resident above you takes off a shoe before going to bed. And then you'd wait anxiously for the second one, knowing that you won't be able to sleep until you're sure that that second thump will wake you. Design improvements, obviously, in apartment buildings have removed the practical context of this saying, but the idiom has returned to the multifamily industry as the past effects and current uncertainties of this crisis continue to produce anxiety about what is yet to come. Now, it's my thought process that it could be that the other shoe has already dropped, but we just didn't hear it. A better perspective, however, is for investors to stop waiting on catastrophe and start examining the immediate and long-term needs that will drive the multifamily market for the next months and the years to come. And so, as Stephen Covey said, I always want to start with the end in mind. And our end in mind is to buy cash flowing real estate, specifically wedge deals that allow us to increase the value over time. And so that's never going to stop for us, no matter what's happening in the economy. But there are factors that we have to evaluate. And the first factor I want to evaluate is the National Multifamily Housing Council's rent payment tracker, which found that 80.2% of apartment households made a full or partial rent payment by May 6 in its survey of 11.4 million units of professionally managed apartment complexes across the country. Now, this is a 1.5% decrease in the share who paid rent through May 6th of last year. But it also needs to be noted that this compares to 78% that had paid by April 6th of 2020. And so we're actually, doing better in May than we were in April at this period of time. And this data encompasses a wide variety of market rental properties across the United States, which obviously vary by size, type, and average rental price. And so, despite the fact that over 20 million people lost their jobs in April for the second month in a row, we're seeing evidence that apartment renters who can pay rent are stepping up and doing so. And that was Doug Bibby of the NMHC. And they expect May to largely mirror April, when the payment rate increased throughout the month as financial assistance worked its way into people's bank accounts. So that's a really good sign for the apartment complex industry and the multifamily asset classes. What I want to talk about now is an interesting take of kind of why asset prices may actually increase, and that this is a very interesting kind of take, and there's some great data that backs this up. But in 1 month's time since March 2020, the M1 money, or the supply of quickly available money, example might be checking account deposits, has increased over $1 trillion. For context, during the last recession and into the recovery, it took from November 2008, when the first quantitative easing started, to December 2012 for the same movement. So in little over a month, we have seen the base money supply increase by a similar amount that took over 4 years a decade ago. To boot, we have not even seen nearly the end of expansion, as the large jump has a lot to do with direct injection of capital into people's bank accounts, and quantitative easing has not had time to filter into the system and add to this money supply yet. And so the second chart that we can look at and that I'm tracking is the expansion of the Fed's balance sheet. And again, we're seeing massive expansion here in a short period of time. The Fed balance sheet reflects the quantitative easing and other asset purchases, which they may have expanded into the municipal and high yield debt markets. And they did this for several reasons. One of the most prominent being propping up asset classes, asset prices to avoid asset deflation, which crushes the bank's balance sheets and was one of the major causes of the Great Depression. Asset purchases by the Fed ultimately causes risk premium to be artificially compressed and investors to embark on a desperate search for yield. So we've seen this over the past 10 years, and the yields have become depressed in every asset class. And just think through the cap rates for commercial real estate. So how does all this filter through to asset prices? Well, ultimately, asset prices are driven by current levels of the interest rate, the risk premiums, and the available liquidity or the demand in the market. And you have a risk-free rate in the United States Treasuries to which you add a spread, the risk premium plus the investor demand. And at this point, we're having influenced every point of the equation. So the quantitative easing is driving down the risk-free rates by buying treasuries. The Fed is pushing in risk premiums by entering the high-yield debt space. And the money supply is expanding faster than any time in history through direct distributions, credit, and the Fed asset prices. So, one might argue that you're already seeing this filter through the system, and the stock market back near all-time highs is a great example for this. So while equities are forward-looking, it would also make sense that this is in part driven by asset inflation, as the underlying economy is still under massive duress and distress. And we're also seeing examples of this in the commercial real estate market through the amount of people that are looking for quote-unquote discounts and distress note sales. So anyone on LinkedIn or any of the social medias has seen the explosion of people looking to buy notes, and anyone in the commercial real estate finance space has fielded probably dozens, if not hundreds, of calls from buyers looking to pick up paper. And so we're actually seeing more equity chase deals right now than at the end of the last year. A lot of it's looking for the right deals, in the term quote-unquote pre-COVID seems to be passed around a lot, but eventually that bid-ask spread will be compressed, and I believe the compression will be mainly due to buyers coming up in price. And as I'm seeing more and more buyers than sellers equaling more liquidity, cheap financing, and quantitative easing still available, and more lenders coming back into the market, and ultimately tighter risk premium, so the high yield asset purchases, as the economy begins to normalize and assets with stable yields, they might become more apparent. So why are we already getting a discount? Because if you buy an asset that arguably has and will have a stable yield today, yes, there may be short-term disruption once the price adjusts to the market yield, and will do so quickly. The prices could be much higher than they were pre-COVID. So I would really say that this is an opportunity to think through all of these different factors playing into your purchase. The last thing I want to talk about in relation to just commercial real estate in general is the inflation hedge. So inflation occurs when the nominal supply of dollars grows faster than the real demand to hold dollars. However, in the short and medium term, inflation may be largely affected by supply and demand pressures in the economy, and influenced by the relative elasticity of wages, prices, and level of interest rates. So in the United States, inflation is estimated by calculating the rate of change of the Consumer Price Index. The CPI measures the prices of selections of goods and services purchased by the typical consumer. The magnitude of inflation, the inflation rate, is usually reported as the annualized percentage growth of the CPI index. Investors widely consider commercial real estate an asset class that can help offset the impact of inflation over time. In fact, that benefit is regularly cited as one of the advantages of adding real estate to a mixed asset portfolio of investments. And academic literature on the inflation hedging benefits of real estate are mixed, but generally agree that private real estate is at least a partial hedge against inflation. The ability to adjust the rents over time is typically credited for real estate's inflation hedging benefits, and typically a robust economic growth should result in higher inflation and therefore stronger rent growth. So those are some serious factors to take into consideration, and some great points that were made not only by myself but from some really smart people that I follow here on LinkedIn, Jake Clopton being one of them, that we work on some projects together. Now let's dive into